Hi, the video that you're about to watch is a recording of a free educational webinar that we at Bloomfield Financial put on at regular intervals. If you'd be interested in attending future webinars, you can sign up for them at bloomfieldfinancial.co.uk/webinars. And if, when you review the list, there isn't anything that appeals to you, you'd like to be notified of new webinars, pop your details in and we'll drop you an email when we add to the list. Please bear in mind when watching the webinar that it was recorded in the past and the information may become out of date over time. At the time of uploading, it's still accurate and the date of the presentation is on the webinar itself. We don't upload every webinar that we present because it may be more likely to become out of date quickly. So if you would like to attend a webinar, please feel free to register. And if you can't attend, register anyway and you'll get a recording of the webinar that'll stay up for a few days if it is a time-sensitive matter or something that's likely to become out of date relatively quickly. If you have any queries, questions, please, as always, don't take these videos as personalised independent financial advice. Seek out a financial advisor to get the advice that you require, and please feel free to contact us. So hopefully everybody can hear me. The system's telling me that my audio is going out. But this is the first time using this system. I've done a couple of tests, but obviously if anything's going to go wrong with it, it will be when it's being used for real. If anything does go wrong, the recording will be sent out later on today to your email address and be available for a little while, depending on how long compliance say, based upon what I say during the presentation itself. So I should mention before we get started that recently I've had a chest infection, which has left me with a little bit of damage to my vocal cords, which means every once in a while they lock up and I can't breathe and I turn blue. So if I go quiet and turn blue, don't call an ambulance because within 20 seconds or so I'll return to normal, although probably a bit croaky. So individual savings accounts, or ISAs, as they're most commonly known, is the subject of today's webinar, but a couple of little bits of housekeeping, as it were, to run through first. Please stay muted if you can so that everyone can hear. I'll have my speakers off, so I won't hear you, just so that there's no feedback on my microphone. Questions can be asked in the Q&A box, which should be on the left-hand side of your screen or on the bottom bar, depending on what sort of device you're using. The recording will be available before the end of the day, but it will be available for limited time, as I've already said, depending on how long compliance thinks the information is valid for or likely to be valid for. And just to emphasise that any webinars we do are educational and not personal advice, so they may not be completely applicable in your situation. So making sure you can't sue us if you follow something that's specifically in the webinar because it wasn't based on your personal situation. And because we're going to discuss investments during this, there are a couple of regulatory warnings that we have to run through, which you've probably seen many times before. The first being past performance is not a reliable indicator of future results, which I think people have become a bit blind to these. Generally, what that means is, obviously we use past performance data of both assets and funds and things when investment advisors make decisions, but they can't predict the future. Just because something's been good in the past doesn't mean it's guaranteed to be good in the future. The value of investments and the income from them may rise or fall. Again, another fairly obvious one, but things go up and down in value when they're investments versus savings. And the other one is your capital at risk. Investments can fluctuate in value. Investors may not get back the amount they invest. Again, very similar to the one above. Standard regulatory warning, which is to tell you that if you put money in and you take it out when it's gone down, you're going to get less out than you put in. So on to the actual subject matter, individual savings accounts. Individual savings accounts are not actually a financial product, they are a tax wrapper. There's a difference between what a tax wrapper is and a financial product, and I think it's worth explaining it to give people an overview of what ISAs really are. So a tax wrapper is created by government. It's an allowance or a tax break available to certain accounts and providers that comply with the rules set for the tax wrapper. The government will set minimum regulations for how the account that's been approved to be an ISA, in this case, can be operated. The product is what financial institutions do with those rules. So they apply to use the ISA wrapper. They'll tell show what their product's going to be. And if it complies with the minimum standards that the government want, then they will get approval. And if they are regulated, etc., to do these sort of things. But they add their own rules on top. So, for example, there's no rules in relation to ISAs about access, how long you have to wait with it. But an individual provider could place a withdrawal time frame on their actual withdrawals from their product, and it can still be designated an ISA. So the advantages of ISAs, or individual savings accounts, as a tax wrapper, is that there are tax breaks and incentives applied to the ISAs. ISAs are quite unusual in that incentives have been applied. So taxes and ISAs. Income tax is not charged on ISA investments, regardless of what type of ISA it is. So all interest in dividends or all interest in savings or dividends paid on investments are free of any personal income tax. There is internal tax within the funds, but that's something that the investor never sees. But your own personal income tax isn't affected if the money's held within an ISA. You currently do have a savings allowance under current legislations, which does make the income tax savings, particularly on deposit accounts, interest, less attractive. The savings allowance is an amount of money that you're allowed to earn every year from interest on your bank account savings without paying any tax on it, regardless of whether it's an ISA or not. But if you were paying tax via your bank account either because you had no savings allowance, because it's not the same for everybody, or you were using it up because you had so much savings, you'd be charged at your highest tax rate. If the money's in an ISA, you wouldn't be charged at all. Capital gains tax is the other main tax that is protected for money that's in an ISA. A lot of people don't know what capital gains tax is, but basically, if you invest £100 and then you sell it later for £200, you've made a gain of £100 and you'll be charged capital gains tax on that. So it only becomes payable when you actually sell something or surrender an investment. So that could be 1 year, that could be 20 years later. And the charge is based upon how much you made on the investment. Current rates for capital gains tax are 10 or 20%, depending on your tax brand. There are other rates for property, but we'll stick to this because this is ISAs. You have an annual exemption of £3,000, but that's not cumulative. So if you buy something today and you sell it in 20 years' time, and the exemption was still £3,000, and you made £60,000 profit, that wouldn't be exempt because you don't get to use all your £3,000 over that 20 years. You only get to use the £3,000 in that final year. ISAs are not exempt from inheritance tax. When you die, the balance of any ISAs is considered as part of your estate. If you have a spouse, they can be transferred to the spouse and keep their protection from income tax and capital gains tax, but they are still assessed for inheritance tax. ISAs are unusual in that the government has applied incentives to ISAs in the form of bonuses over the years. They started that with the Help to Buy ISA, which is no longer available, and it still exists with lifetime ISAs. Essentially, the bonuses are a 25% boost where you follow the rules and a 25% penalty if you do not. Bonus lost if you don't, not a penalty, is what the government would say, but we'll get to the maths later on that, and actually there is a bit of a penalty to it. So they've been used to drive government policy. So lifetime ISAs are focused on getting people to save for retirement, but not using pensions because that's cheaper for the government, and using them towards first-time house purchases. So the question is, are pensions better if you're saving for retirement? And the answer is generally yes, but there are access restrictions to pensions. You can't access them currently till you're 55. ISAs, other than lifetime ISAs, you can access at any time. So that's the main problem with pensions, and the age that you can access a pension is due to rise. The objective is that it should be 10 years below the state pension age. However, the legislation hasn't been passed properly, and it gets done in little bits in order to keep that going, but it's expected to rise 57 soon. So how to use your ISA allowances: investments versus savings. So individual savings accounts, you can use them for savings, as in the name, but you can also use them for investments. Savings being cash deposits. The advantage of cash deposits is they can't go down in pound value. Real values in our story, obviously inflation, etc., can damage cash values over time quite dramatically. They'll only ever incur income tax on interest. Cash savings don't make a capital gain. It's just interest. The attractiveness of using them for savings has been reduced a little bit because of personal savings allowances. Will you actually exceed your tax-free savings allowance? At the moment, for a basic rate taxpayer, the first £1,000 of interest that you earn is tax-free. For a higher rate taxpayer, it's £500. If you're an additional rate taxpayer, i.e. you earn more £125,000 a year, then you don't have a savings allowance. So interest rates are a bit higher at the moment, so some people are going over their personal savings allowance. But over the last few years, when interest rates have been tiny, that hasn't been the case. With investments, an investment can rise and fall in value in the long term. It's more likely to provide better returns, hopefully to offset inflation at the very least. It can incur income tax on dividends paid, and it'll usually incur capital gains tax when you actually come to surrender the investments. But obviously within an ISA, it's exempt from both of those things. Now, you've got to make a choice when you put your money in whether you're going to use cash savings or investments, but you can split it. But the good thing about ISAs nowadays is they can be converted. You can convert a cash ISA to an investment ISA, and you can convert an investment ISA back to a cash ISA. And you can do it over and over again as many times as you want to. But if you're investing and you're saving, and you've got to choose what you're going to use your ISA allowance for, investments are generally the winner, because you're going to save yourself from capital gains tax, which is a bigger benefit over the long term, potentially, than income tax. Now, we say potentially because rules change all the time, allowances change all the time, but you can only act on what the regulations are today. So allowances and eligibility, ISA rules and the ISA types. So talk about what type of ISA are available and what the rules are surrounding them. So everybody has an overall ISA allowance every year. It's currently £20,000 per tax year that you can pay in as a maximum. You can pay in less. The minimum is £1 usually. An allowance is individual. There's no such thing as a joint ISA, hence the I standing for individual. And your allowance renews each tax year. It hasn't always been £20,000. It used to be less, and it may change in the future to become more or less. And of course, ISAs may be scrapped entirely. But generally in the UK, when there are big financial changes made, they're always in the future. So things that already exist are normally protected. If you want to change product provider, you must transfer from one ISA to another provider to another. So if you have a cash ISA with Santander and you want to move it to HSBC, you don't go to Santander and withdraw the money and take it across the road to HSBC. You go to HSBC, give them your Santander account number, and they will request a transfer. That's how you preserve your ISA allowance on the money you put in previous years. You can only take money out of an ISA and put it back in the same tax year to keep your allowance if the ISA is deemed flexible. So the government allow it if the ISA is deemed flexible and there aren't actually that many of them around. So in that scenario, say you put £20,000 into a cash ISA with a bank and you needed £10,000, but you wanted to put it back. If it's a flexible ISA, you can, as long as you're done within the same tax year that you put the money in to begin with. But with most ISAs, you can't. So if that's something that's likely to happen for you with cash savings, with cash ISAs particularly, then you need to make sure you're getting a flexible ISA when you open your account. You can have more than one ISA in a tax year. So you can have a cash ISA, you can have a stocks and shares ISA, you can also have a lifetime ISA, but your total contributions cannot exceed your limit. So if you put £8,000 into your cash ISA, then you're left with £12,000 you can put into your stocks and shares or investment ISA. And you can't have £8,000 in a stocks and shares ISA with the Halifax and £12,000 into a stocks and shares ISA with HSBC in the same tax year. You can only open one with one provider per year. but your cash versus stocks and shares can be with different providers. And the ISAs that you opened in previous years, they can be left with those providers. You can have a new provider each year if you want. So cash ISAs or savings ISAs, you've got to be UK tax resident at the time of paying your money in. But if you leave the UK, it still keeps its ISA. Allowances and ISA provisions just can't put any more money in. According to the regulations, you are supposed to inform the ISA provider that you have left the UK and are unlikely to return, particularly once your tax status changes to non-resident. They can impose their own rules to make you transfer out to somebody else, but that's not a government rule, that's their choice. You've got to be over 18 to open an ISA. Again, it's a maximum of £20,000 per person in the current tax year. Anything you put in reduces your allowance for other sorts of ISA in that tax year. Just like any other savings account, the banks, bill size, whoever, have made different versions of them. So you can have instant access ISA, fixed rate ISAs, they can place withdrawal limits on them, and their own sets of rules. So you can, you have to follow those rules. So make sure you know what you're getting when you open an account. Rates are not always better than standard savings accounts, particularly at the moment. You can transfer past year's ISAs to new providers whenever you like. So you can consolidate all your old ISAs and your new one with one account, with one bank bill site if you want to. And again, as I said before, investment ISAs can be converted to cash ISAs by transfer. So often the stocks and shares on an investment ISA provider won't have a cash ISA available internally, so you would just transfer it to a cash ISA provider in the same way we talked about before. The question that's often raised these days is, if rates are not better than standard savings accounts, why bother with a cash ISA at all? Particularly now that we have the savings allowance, and some people think, well, why bother using the ISA at all? Things change and your allowance doesn't carry forward, so you use it or lose it. And by using your ISA allowance first every year, you're going to accumulate your allowance over time. So you can see it builds up quite quickly. So even though the cash ISA rates might not be better at the moment, if you keep using them, 5 years' time, you'd have £100,000 that's already sheltered from those taxes. If the rates are better there, then great. But equally, if you suddenly were in a position where you were ready to start investing, and you can convert that to an investment ISA. So these can be a great account to build up when you're building up your emergency fund before you're actually ready to start investing. And then maybe in the subsequent years, you can start converting them to investment ISAs when you're more financially stable. So stocks and shares or investment ISAs. I prefer to use the term investment ISAs because I think stocks and shares just gives the impression that you have to go and buy individual shares in companies. Again, you have to be UK tax resident at the time of the investment. They have to be over 18. Again, if you leave the UK, they can stay in place, still get the same tax protection. You're supposed to inform the provider that you're no longer tax resident in the UK, and they can make you transfer to somebody else, or they can force you to cash out, but there's no legal requirement for them to do that. It's not a government force them to do that. That's their own choice. Again, maximum allowance is still £20,000 per person this current tax year. Anything you use in your stocks and shares or investment ISAs reduces how much you have available to put into the other types of ISAs, but it's an overall allowance still. Stocks and shares ISAs can hold investment funds. It's the most common thing. Direct shares, corporate bonds, government bonds or gilts. And again, they can be converted to and from cash ISAs. Now, a lifetime ISA is a relatively new addition. Replaced the Help to Buy ISA essentially. Again, UK tax resident at the time of investment. Same rules apply as you go abroad as they do with the rest of them. And you've got to be over 18 and under 40 when you first open the account. That's the unusual bit. And you can't contribute once you're past the age of 50. So if you open it when you're 40, you've got 10 years you can pay in for, and then you have to stop. You can only pay in a maximum of £4,000 per person this current tax year, and that'll reduce your allowance for other ISA types to £16,000. They can be investments, they can be cash, they can be both. They're usually with one single provider though, so you generally in the real world have to make a choice between investments and cash. They don't know of anybody who offers you to hold both, even though there's no legal restriction to stop them at the moment. The government gives a 25% bonus annually based on what you've paid in. So if you pay £4,000 in, you'll get £1,000 bonus added to your account. But there are withdrawal restrictions. The bonus is being used to shape government policy. So you pay a penalty of 25%, same percentage as a bonus, unless you withdraw unless you're withdrawn because you're buying your first home, or you're over 60, or you're terminally ill with less than 12 months to live, and a doctor has to have certified that. So it sounds fine, they're just taking back the penalty from the bonus from you if you cash out early, so why wouldn't you use them? And something else to bear in mind is, because at the moment, they haven't been around very long, most people don't have a lot of money in them. It's difficult to transfer them to new providers because the providers of accounts aren't really that interested in holding them because they're not a high profit product. As time goes on, if these stay in place and people's balances go up, I'm sure more and more providers will be interested in allowing you to transfer in. But if we do the maths on the penalty, it could be worse than it sounds if you pay money in and expect to get it out and need to get it out quickly. So if you deposit £4,000, you've got £4,000. You'll receive your bonus, which will take it to £5,000. But if you need to withdraw the £5,000 immediately, the penalty is 25%. So it's £1,250, which obviously is more than the bonus was. So you end up with £3,750. So you've lost £250. Now, obviously, this assumes that you've had no growth or interest. I'm sure those of you who are good at maths will have realised that you basically need 5% growth on each deposit in order to offset the bonus if you the penalty or charge if you withdraw early. And that would only make you break even. Now, the reason you withdraw, of course, matters. There are the exemptions. But and some people use lifetime ISAs to hold money that really is for retirement, but they don't know when or if they can really afford to put that money into the pension, so they want to know it's accessible. So if the reason you withdraw is because you're going to move the money straight into your pension, then if we look at those figures again, and you deposit the £3,750 into your pension, you get an instant tax rebate based upon basic rate of £937.50. If you're a higher rate taxpayer or additional rate, just use higher rate as the example, you will be able to claim relief by your self-assessment of a further £1,562.50. So the value to you of moving that £3,750 into your pension would have been £5,937.50 for basic rate taxpayer, £6,250 for a higher rate taxpayer, a little bit more for additional rate taxpayers. But if it was always going to be for the pension, you'd be better off paying in the pension to begin with. And then we have junior ISAs. Now, junior ISAs, as the name implies, are for children, with the exception, the child must live in the UK, with the exception of the children of Crown servants living abroad with parents. That's diplomats, soldiers, etc. The actual wording is dependent children. So in theory, if a soldier was serving in Germany and it sent his child to boarding school in Switzerland, they would still be eligible. So they don't actually have to be living with the parents, they just have to be living abroad. And it's not actually parents, it's anybody who has parental responsibility for them. Child must be under 18, obviously, otherwise they're not legally defined as a child anymore. And the account can only be opened by a person or an organisation with parental responsibility. So an organisation could be social services, for example. The current maximum is £9,000 per year that can be paid into the child's ISA, and it doesn't affect the parents' allowances. Junior ISAs can hold investments, cash, or both. but the child can only have one in any tax year. So I don't know of any providers who let you hold both. So you generally are making a choice between investments or cash each year. It simply converts to an adult ISA at age 18 automatically, and then they get the ability to convert them backwards and forwards between investments and cash, etc., as anybody else would. Anyone can contribute to the account once it's up and running, so grandparents can pay in, anybody you want. That. But many parents worry about control, because when the child turns 18, they get total control over the account automatically. There's nothing the parents can do to put a stop to that. So if your child is not somebody that you want to be giving large sums of money to at 18 because they're not responsible enough, obviously £9,000 a year for 18 years is not an insignificant sum if you were maxing it out from birth. So many parents worry about control and end up using non-ISA accounts so that are in their own name in order to avoid any issues. And some just don't tell their kids that the accounts exist and try to hide them, which obviously I'm not condoning, but depending on your household, that might be practical. And the final type of ISA that we currently have is called an innovative finance ISA. These are relatively new, and you probably haven't heard much about them because the FCA has placed extremely strict restrictions on how they are marketed. Again, you have to be a UK tax resident and over 18. Again, it's part of your maximum £20,000 per person allowance. Essentially, these are peer-to-peer lending platforms. So you put your money into the peer-to-peer lending platform, they find somebody who wants to borrow that money. So the borrowers could be people, they could be businesses. Your return is going to be the interest that they're being charged on that loan minus a charge by the peer-to-peer lending platform. You can lose money if the person who's borrowed the money fails to repay it, or the platform collapses, and that has happened. The platforms normally have some sort of capital reserve in order to try and keep your payments going, but it's not enough to cover everybody usually. And withdrawals can take months if you need to get your money back out, because they have to call in the loan from the investor, from the borrower, if you haven't been taking a regular withdrawal in the first place. And crucially, they're not covered by the Financial Services Compensation Scheme like all our ISAs are. So if they go bust, there is no government backed or financial services backed compensation for the plans. They can be converted by transfer to cash stroke investment ISAs. But as I say, the Financial Conduct Authority is so concerned about peer-to-peer lending, they've made it a specialist authorization for advisors, and they've placed rules that mean that the companies that offer these things are only allowed to actively market them to people that they can prove are extremely high net worth or extremely sophisticated investors. So you won't normally come across these things in your day-to-day life. Right, so practicalities. Opening ISA accounts. So cash ISAs, including the junior or lifetime version. You can open with any institution that has a banking license on the high street or online. When you're looking for an account, make sure that you get the access terms that suit you at the best rate you can. So lots of search engines and things online to help you do that. If you're one of our clients with an ongoing service, we can do that for you. But make sure you look at what the access requirements are. Although there's no specific access requirements on ISAs from the government, as part of the tax wrapper, individual providers will apply them. And remember, when transferring ISAs, you always do it by going to the company you want the new account with, and they will get your money from the old account. If you withdraw, you'll lose your ISA protection. And remember, the Financial Services Compensation Scheme limits do apply to ISAs. So the Financial Services Compensation Scheme protects deposits up to £85,000 in total across all accounts you hold within the bank or banking group's license. So, for example, some banks might have different brands, but they are the same bank, so they have operate under the same license. So ISAs can get quite large over time. So some people like to keep them split down so that their individual accounts are less than £85,000 in order to make sure they've got financial services compensation scheme protection. But make sure that the banks that you're using are not part of the same group. This is something that we automatically check for our clients if we are researching deposit accounts for them. Investment ISAs, including junior and lifetime versions. Again, you can open any institution that is FCA or PR approved to provide them. So this could be a high street bank, an online platform, via a financial advisor, I should say. Or sometimes you might find your employer's pension scheme has these available on particularly good terms, because there are charges on any form of investment because the investment house isn't using your money to do anything other than buy the investment. So their charges are always explicit. You'll need to choose your underlying investment funds. Some services will offer guidance where you'll go through questionnaires online, etc., and they'll lead you to a selection of things they think might be appropriate for you. And some will offer advice. There's a big difference. So make sure you understand what the difference is. If you get advice in the financial services context, it means the person who gave you the advice has taken your personal circumstances into account, and they are liable if that advice turns out in the future to be wrong. If you just received guidance, there's no liability unless somehow the guidance was fundamentally flawed. But they're generally not taking your personal circumstances into account if you do a questionnaire or whatever. So a classic one as an example is you came to a financial advisor and you wanted to open an investment ISA and you had no savings whatsoever. Pretty much every financial advisor would tell you to start regular saving, get some cash built up first, then consider investments, because you need to be investing for the longer term. And if you've got no cash to fall back on, you're more likely to pull out at the wrong time. If you go through a guidance service, you rarely get asked that question. And if you do get asked that question, they might advise you it's not a good idea, but they won't be as firm with it. When transferring ISAs, again, always go to the company you want your new ISA with, and they will get the money from the old one. And they are covered by the Financial Services Compensation Scheme. The usual limits do apply, but it's much more robust on investments because of the layers and depending on how the plan's structured. That's another subject. Innovative finance ISAs, if you wanted one of those, just remember they are very high risk. You need to open them with a peer-to-peer lending platform, and you actively have to find that yourself because they don't market to people unless they've actually identified them as being high net worth or sophisticated investor, which is very difficult to do. But Google will find them for you if you really want one. Again, when transferring, same thing applies. You always go to the people that you want to account with, and they'll get it from the old account. But remember, the Financial Services Compensation Scheme does not cover these in any way, shape, or form. That's the summary of ISAs. Have a look, see if there's any questions in this question box, and I'll answer those if there are. This is your chance to put them in. But we've got some upcoming webinars on July 17th is the pensions annual allowance, July 31st, reality is a buy-to-let, and August 8th is a 60% tax trap. If you scan this code, it'll take you to a page on our website where we add the webinars and details of what's coming up and where you can register, find out further information, etc. And if you have any suggestions for subjects that you would like us to cover, then please feel free to just drop us an email to let us know. So there's no questions in the chat box, in the question and answer box that I haven't covered in the presentation. So I will let you go, and an email will come out later in the day, which will give you a link to the video if you need to rewatch and go over anything. You'll get an email at the end as well, which will have a link to a little survey to find out how this went. This is the first one we've done, see what you think about it, and whether the software worked okay for you, and all those sort of things. So thanks very much for your time, and hope you have a good day.